So let's start with important macroeconomic events next week. So Monday is April 1st, April Fool's Day. Let's see what kind of tricks the markets pull on us. As far as important data is concerned, so next week is all littered with Fed speak. So you can see, Fed Bowman speaks, Fed Loretta Mester speaks, Fed Daily speaks. It's all over the week. Bowman on Wednesday again. The important stuff is anything that is jobs related would be important. So job openings on Tuesday might be slightly important, but the ADP employment data, which comes on Wednesday, that is known to move the market. So watch out for that. And then on Wednesday, Jerome Powell also speaks. So, whenever he speaks, markets are always looking for clues. So you never know what kind of reaction you may get. But watch out for that on Wednesday. And then, Thursday we have the weekly jobless claims which comes out, and every week it moves the market. So that's any job related data will move the markets. And then it's again full of all these Fed presidents. I've stopped listening to them. I used to listen to them because they have they talk like politicians now. So I would just classify all of this as bunch of Fed speak. It's basically meaningless except Powell's speech. So that's the macroeconomic events next week. As earnings are concerned, earning season is pretty much dead at this point, and you can see in this earnings calendar, none of the stocks from our watch list are reporting. So earnings are over, but you have just one more week to wait before things start getting crazy again, because starting the second week of April, starting on Friday, is when all the big banks start reporting earnings. The week after that, Netflix starts reporting earnings. So things are going to get crazy pretty soon. Okay, so I've recently started introducing RRG charts to our group, and I'll link a video below which shows you how to interpret the RRG charts. But a quick reminder that it has four quadrants: improving, leading, weakening, and lagging. And it basically shows you how money is flowing in the markets, where the money is coming out, which sectors the money is coming out, and which sectors money is flowing in. I pay attention to only lagging and leading sectors. Let me center this for real quick. Lagging and leading sectors, and the weakening and improving, I don't really care about them, because based on my own experience, these are transitory phase. So things are in flux. So for example, XLK, you can see here, XLK is in the weakening sector. It has been for a few weeks, because you can see tech is slightly under pressure. Dow Jones is moving up, but tech, QQQ, the chips, they're all slightly under pressure. So XLK has dropped from leading to weakening. However, if you take trades based on the weakening quadrant, you are most likely to get chopped out. And I'll give you an example. So on this side we have a calendar, and as I move the calendar, it shows you on which date where the sectors were. And as I move the calendar forward, it shows you the sector rotation happening, which is really cool. Note that, let me go back to June 26th, and you can see XLK, technology sector, was the leading sector. And it has been the entire of last year and most of this year so far, because of the AI bubble we are in. Now notice, as I move the calendar forward, it will start showing you a cool animation of how that sector is, how these sectors are moving, how the money flow is happening. So if you, on July 31st, if you were taking bearish trades based on XLK moving from leading to weakening, note what happens. It goes to weakening and it goes back into the leading quadrant. So that is the reason I stopped paying attention to these two, because these are like showing sectors which are in flux. There is no clear direction when a sector is in improving or weakening. All we can say is when something is in lagging and leading, then you need to pay attention. Meaning, if a sector is in leading, don't take bearish bets on that. For example, tech on November 27th. And if a sector is in lagging, industrials or consumer discretionary, then don't take bullish trades on that. So that's how you can use this. But again, let's go back to today's date. XLK is weakening. So unless XLK starts entering this lagging zone, first of all, I don't expect any correction coming anytime soon. Tech has led this entire rally for the last 5 months, and tech and semiconductors, they are the ones who will lead us into a correction. And so for that, this XLK sector needs to drop into the lagging quadrant, and you will see it happening if it happens. So that's how the RRG charts look like. So as I mentioned in last week's outlook, XLC communication sector is very, very strong. Do not bet bearish on this sector. And I gave you an example. Netflix and Disney are two stocks in this sector. And you can see both of them are going up. Financials is finally dropping out of favor, but if you want to take bearish bets, you could consider utilities, XLU, consumer discretionary, XLY. XLV is healthcare. But one more thing I want to point out is when you use these RRG charts, what I have found in my own experience is the sectors which are towards the end of this circle, right? They are the ones who are more reliable. So if something is rotating right around the center point, it's not very reliable. For example, XLE is towards the end. So I don't know how XLE behaved. So if you look, XLE has been going like this. So XLE is a good candidate to use RRG charts. But XLV, for example, it's just moving right here. So anything which is just rotating around the center, don't pay too much attention to those sectors. Anyway, so that's RRG. Okay, so now let's look at a few indicators that I use as signs of divergence. So number one is 10-year Treasury yields, which is shown here, TNX, at the bottom left. So 10-year Treasury yields have been on the rise since January 1st, with minor dips every now and then, but the overall trend is still up. We're kind of stuck in this zone right now, but with Treasury yields, my prediction was that if Treasury yields start going above this level, like 45, that will coincide with the market correction, because equities, especially growth and Russell, which has been killing it, Russell 2000, cannot stay up if interest rates are high. So watch out for that. If TNX breaks out of this level in the future, like 44 level, that's when things will start getting interesting. Right now, it's pretty boring. It's just going sideways. So that's TNX. Next, let's look at oil. So oil, this is the 6-month chart. So you can see going into December, this is December 15th. Markets have been dumping since, I don't know, for last 2 months. Oil futures have been going down. And that usually overlaps with lower inflation, because oil prices go down, inflation, it affects everything. But starting January, I would say even December end, oil has been on the rise constantly, and this will eventually bleed into those CPI, PPI, PCE, all those inflation readings that markets are so obsessed with. So, in fact, I read one article that oil could go back to 100. Right now it's at 83. So watch out for oil. Another sign of divergence. Third sign of divergence is dollar index, US dollar index, which has been on the rise again. And if it's this is the resistance right now, 105. If it breaches 105 and goes past that, that is another sign of trouble for US equity markets. And finally, the only black sheep which is not showing any signs of divergence is VIX. Everything else is showing, the TNX is kind of stuck in the range. Oil and dollar index are going up, which is not good for equity markets. But VIX is the only thing that is still crushed to multi-year lows. So unless I've been pointing this out for many weeks now, unless VIX breaches that 16 resistance and starts trading above that for at least a week, we are not going to see a correction in price. What could happen is markets are now just waiting for the earnings season to come, because earnings season is just 2 weeks away. So in 2 weeks, Netflix and all those companies will start reporting. And if Netflix again hits it out of the park, then this rally will just continue. And as you know, I have been waiting for a correction, but that will, if the earnings season starting next week Friday, when the big banks start reporting, if the earnings season starts with blowout earnings, I'll just have to bite the bullet and start taking bullish trades. If you want to watch just one indicator, just watch VIX. Let's switch to, I have all these watch lists in my Think or Swim. I'm pretty organized that way. So I have my watch list, I have sectors, I have a watch list called Market Pulse, then FANG stock. So let's just start going through some of these interesting things. Okay, so let's start with the indices. So I'll start with SPY. So if you have been reading my market outlooks, or if you may have watched a few recent videos that I've been posting on YouTube, I have removed all my usual indicators like Bollinger Bands, Keltner channels, DMI. And all I've done is added 3 moving averages, which are shown with blue, yellow, and pink color. And then at the bottom, I do have RSI. And what I've been pointing out is that many traders use moving averages as a trend reversal indicator, right? Moving average crossovers. So this is, if you notice, the blue line crossing over the yellow line on November 3rd. So if you're an aggressive trader, you could have started taking bullish trades at that time. But if you are looking for confirmation, that would have happened here when the blue line crosses over the pink line on 11/7, November 7th, which is again, this is 8-day moving average, 21-day and 34-day. So that is your sign where you could go bullish. And as long as the blue stays above yellow, you keep taking more bullish trades than bearish. And for anybody looking to go bear heavy, I have been suggesting that wait for this guy, the blue line, to cross below the yellow line, which is the 21-day EMA. That would be a first sign that you could start entertaining some bearish trades. And then once it crosses below the pink line, that will be like a proper trend reversal moment. And then that will eventually lead us into either a sizable pullback or a big correction. But until that happens, until the blue line crosses below yellow, I would say either keep trading low. So I've been just doing one contract trades. Usually I do like 4 to 5 contract trades, but I've been doing one. So I've cut down my trading volume drastically. On my smaller accounts, I'm not even taking any trades. So use moving averages as your friend. And then, although I have plotted these Fibonacci retracements, we haven't gotten any pullback yet. So markets are still going up. But the reason I have done that is, if we get a correction, if the blue line crosses below yellow and we start going into pullback, we could start entertaining downside price targets. And in one of my previous outlooks, I have mentioned that 38.2 seems like a good area of confluence because of support coinciding with that level of retracement. So markets could come down here, SPY could come down here before it bounces back. That's the first downside target. But again, no point talking about it because it hasn't happened yet. So that's SPY. Now, DIA, Dow Jones, is looking very strong. Um, you can see that it's about to break out of this. The last high was 398. It's almost about to break out of that. So we'll see next week what happens. QQQ is the only one that is showing some signs of weakness. The next move will happen after Netflix reports earnings in 2 weeks. I have a feeling until then, either the markets will go into a sideways phase or a TTM squeeze. In fact, let me remove these moving averages, switch to my regular indicators. You can already see that QQQ has entered a squeeze on March 20th. So for the last 10 days, it has been in a squeeze. And as you know, um, during a squeeze period, the Bollinger Bands, the red and green lines, get trapped inside the Keltner channels, which is the gray lines. And as long as you're in that period, don't expect any net price movement. Markets may just chop around in a small range, and that range will keep getting tight. Now that these consolidation periods can last for a long time, but in our case, I think it'll be a maximum of 2 weeks because once the tech stock starts reporting earnings, we will see some massive price movement, and then we'll be out of this phase. So that's QQQ. Another interesting component I watch is IWM, and which is Russell 2000 ETF, or you can watch RUT if you want. RUT, it's the same. Um, with Since I trade IWM, I'll just switch to IWM. So usually these are small cap stocks, you know that. Usually IWM suffers in a high interest rate environment. For some magical reason, Russell 2000 has broken out of all resistance zones. And in fact, let me switch to a 5-year weekly chart so that you can get a zoomed out view of this. So notice this. So Russell 2000 or IWM has been stuck in a range since January 17th, 2022. From this date all the way to December 11th, 2023, Russell 2000 has been stuck in a very tight trading range. It finally broke out on this date, fell back, and then now is again moving upwards. So this range is now gone. This line, which was resistance for almost 2 years, is now support. Now, do notice that we have another area of major resistance coming up very soon, which is around 214. So unless IWM breaks above that, we are still not in a bull market. For now, the short-term resistance is 215. So watch out for that level, since the previous level, which was 200, has already been broken. So that's it for this week. I will continue to put out the video-based market outlooks and see how it's received in our group and from my audience, and go from there.